This week, we have a question from Louie. I mentioned it a couple of weeks ago, and today we're going to dive deeply into this question. What kind of question should you be asking an investor before you do a business deal with them? Stay tuned.
I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium sized businesses while controlling risk. So, if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So, be sure to hit like and be sure to hit subscribe, and let's get to it. Are you thinking of growing your business or beginning a journey into entrepreneurship? Take a shortcut to success by buying an existing and profitable business the right way. Visit businessbuyeradvantage.com and learn more about my online training, group coaching, and consulting services designed to help you win.
All right, I got a question sent in by Louie. I'm going to read it to you. So he says, David, what questions would I ask a prospective investor for buying a business or a real estate project? He's going to fully fund the endeavor, and I will be the operations person. Any and all advice is appreciated. This is awesome because the whole question of investors is something that I've been spending a lot of time thinking about and collating different things that I've talked about over the years for this new module I'm working on for my Business Buyer Advantage online training. And I've kind of got 6 steps sort of sketched out here. And again, we don't have the budget for any B rolls of like or sound effects of like numbers flying across the screen. So you're going to have to use your imagination for those. So step number one, when we talk about getting an investor for any kind of business deal, is initial research and identification, like finding the people to approach to talk to, like who do we think we can get to actually be an investor, and that's not Louis' problem. He's got an investor who's already stepped forward to say, "Hey, I've got funds. I'm ready to do this." Now, Louis has not disclosed in his email if the investor is talking about advancing money for equity and then further getting a loan, for example, from a bank or anything like that. He's just saying, this person has said, "I've got all the cash." So, what kind of conversations should be going on? Well, Louis can proceed directly to step number two, which would be some kind of preliminary discussion on alignment between you as the business person and their investment and what they're looking for. So you want to start talking about things like the goals and vision for the future. Like, what is their expectation? Are they looking to make an investment that will quickly grow in size? And then in a few years' time, there will be some kind of event where they can then cash out and get a great rate of return on their investment? Or are they looking for income going 25 years into the future, like checks every quarter or every month or something like that, right? And so you have to make sure that what you think is a good idea is in alignment with what they think is a good idea as well. Because you said you're going to be the operator, so a lot of people will buy a small business with the intention of owning it for decades and just running it, and having that cash flow. Other people have got different ideas and different time frames. So you have to make sure that you're on an alignment here with the investor. Step number 3 is diligence and vetting. So you are going to have to do, and this is right in the theme of the last 2 episodes of this show, you're going to have to do some due diligence on this investor. Like, who is this person and where does their money come from? And, if they have talk a lot about, wire transfers from South America or something like that, like you should probably be a little bit concerned. Um, like you want to make sure of who you're getting into business with. And so you you want to also do some due diligence, like has this person been found guilty of something bad, or has this person been like censured by the SEC or some kind of state review board for like insurance licenses or like whatever. Like you need to know who you're dealing with. So you want to do some kind of background check on the person to make sure that you're not somehow getting involved with a crook. Remember in the TV show Ozark, There was a guy who walked around with all kinds of money funding all sorts of ventures, and all the people that took his money eventually lived to regret it. And so you don't want to be a person like that. Verify the source of the investment capital. Verify the reality of the investment capital. So if you do a Google search for this term, um, independent sponsor, it's a term that is a new term. These people used to be called uh, unfunded sponsors or something like that. And so here's the deal, though. Okay, in the world of M&A, an independent sponsor is a totally legit real thing. But here's what they do. They find a business deal, they sort of negotiate with the business owner and they say, "Here's the deal I'd like to put together." And then the independent sponsor will then package up the deal and then take it to money partners and usually also find someone else to be an operator. Okay. And so it is a very difficult thing to pull off. And the world of independent sponsors is a very small one. You know, across the United States, like there's not a million of these people. It's a very small group, and they usually have some very deep experience and expertise, and have grown up in the under the wing of someone else doing it, and they kind of learn the ropes, and then they graduate and do it on their own. And because they are raising a lot of capital from investors who are very sophisticated investors and demand like preferred rates of return on their capital before they get paid out and all this kind of thing, they typically are in the world of larger cash flowing operations. So you're probably not going to find an independent sponsor looking at a business that has an SDE of 200 grand, right? They're going to be looking at businesses that are much larger because there's a lot of mouths to feed in their deal structures. Here's the danger for people in the small business space is that there are people that will consume content and learn about independent sponsors, and they'll try to pull off the business model in the much smaller space. And what they could do is they could represent themselves as being an investor when in fact they don't actually have any money. And they could find an operator, which could be you, Louie, and say, we're going to finance the deal. You're going to be the operator. Let's go and look for a deal. All the while waiting for the deal to present itself before going back and arranging funding. And so um, you definitely do not want to deal with a person like that unless they've been forthright in telling you this is what they're doing and they have some kind of credible plan of action that is believable to you and will be believable to sellers about how they really are going to realistically do this. Okay. Very, very, very difficult thing to do. I was at a conference in Cleveland a couple years ago, and actually had breakfast at the table with an independent sponsor who had been in this industry for a really long time, like decades, and had pulled off deals that could be counted on one hand, and they were all significantly larger than the kinds of deals we mostly talk about on this channel. And so you want to make sure that your investor really has money. So when I was a broker and I had someone come along and say, "I want to buy a business," I would say, "How much money do you have?" And they would say, "I have an investor." And I would say, "Great. When are they available to come to the next meeting?" Because I wasn't going to continue to waste my time with someone who just claimed to have an investor. I wanted to meet the investor, and I was going to be looking for some kind of, demonstrable ability to obtain money. And, I live in a small city, so if it was a person I knew of or had heard of, through the business community, like if it was the owner of the GM dealer or something like that, I would probably just, okay, that person says they're going to be your investor. Okay, we'll go with that. But if it was someone I didn't know and someone I never heard of and somebody who I couldn't validate or verify through my own network, then I would be looking for some, demonstrated money. And you should too, Louis. So you should be saying, okay, show me where the money is. Like, show me on your phone, like, log into your trading account, show me your millions of dollars. Like, I need to see that it's real and that you have these funds available. And if they push back or balk at that, then you just have to say, look, we're going to have to demonstrate our ability to do a deal with any seller or any business broker. And so if you can't show me, how are we going to satisfy those people? So you want to make sure you're dealing with someone real. You also want to assess their reputation and even ask for references. And you want to have an idea of what kind of business background they have, what their reputation might be within the investment community. Have they ever done a deal like this before? Have they ever been an investor in someone else's deal? Do they have any experience in business, or in the case of Louis' question, like real estate investing, for example? You want to know if they're the real deal and if they have some experience that's going to be contributing to the success of your operation. Next step, step number 4. Again, imagine a lady in a boxing ring holding up a big number 4. Okay. So, step number 4, negotiation of terms. So, what form is the investment going to take? Like, are you just going to have common shares and the investor is going to own 99% of them and you're going to own 1%? Or are you going to own all of the equity, the common stock, and they're going to invest by lending you the money or lending the business the money? Like, or is it a combination between the 2? Do they want some kind of preferred category of equity or membership in an LLC where they get a return on their money before their capital is returned and then they own a percentage of the business? Like, there's literally 101 ways to structure these things. So you have to then negotiate what is the deal going to look like. And you have to do something that I like to call crafting the security, which is designing what it is that they're going to own as the person who forks over the cash. And do they want to have liability exposure? Do they want to be considered a what's the term that bankers use? A beneficial owner of this business. And so, depending on where you are, different jurisdictions have different rules. If you own a certain percentage or control a certain percentage of a small privately controlled business, then you are considered a beneficial owner. And on all kinds of anti-money laundering, documentation and rules, that person is disclosed as being connected to that firm. If there's going to be a bank involved, someone who's a beneficial owner is often required to be a guarantor on the loan, for example. So you need to know what the details are, what they think they're going to put forward, what they want to get out of the deal, and you have to actually structure this investment so that you both know what you're talking about. If you don't figure this out, if you don't negotiate the terms of the investment, then you could find a business, negotiate for the business, and get to the closing table and literally have the whole thing fall apart, because that's when everything's got to be on paper. Like, that's when all this stuff has to be sorted out. You can't just be like, let's buy the business and figure that stuff out later. Uh, any attorneys attached to this will not let that happen, because the attorney that works for the investor um, may or may not be the same attorney that represents the buyer as a group, you and the investor buying the business. And whoever's representing the investor is going to make sure that they have all the proper documentation locked down to protect their rights if anything should go wrong in your business deal, right? Are they going to be a shareholder? Are they going to be a creditor? Are they going to have some kind of preferred stock? Whatever it is, it's got to be properly documented. And the documentation can't be made unless you have an understanding of what you're doing, what the terms are between the two of you. Step number 5, final agreement and integration. So then this is what I'm talking about. The closing table, you have to have all the final documentation. You will likely accept the investment into some entity, which will be the buyer entity in the business deal or the real estate investment. And so you might create a corporation or something. They are going to put their money into it. Their investment will be solidified in that transaction. And then this new entity with the funding inside of it at the bank will then go and do the acquisition, right? So all of this stuff has to be worked out, as I've said. What is the relationship going to be between the investor and management? What is the day-to-day going to be? Is it strictly going to be you, or do they expect to have input into certain kinds of decisions that meet certain thresholds, for example? You want to know. Um, Confirming the alignment on business strategy. All kinds of things can happen in business, including the need for additional capital. So the two of you need to be in alignment with what your goals are, what your management style is, and what the attitude will be as far as further investment, if that is required. All this stuff has to be worked out, and the day-to-day operations afterwards have to be figured out. If you're going to be the operator, what are they expecting from you aside from maybe money or a rate of return on their investment? What else are they looking for you from you? So that leads me to step 6, which is post-investment monitoring and relationship building. So it would be best to have some kind of formalized expectation or formalized process of what the communication is going to be, what the reporting is going to be to the investor. So if you're going to be paying them like some kind of quarterly dividend or preferred return or interest or coupon, again, depending on how you've structured this thing, then are you also going to be including some kind of quarterly report so that they have an idea of what's going on in the business? What are their expectations, right? Um, the investor's involvement, are they going to come in and help you manage anything? Are they going to be a part of any decision making? All this stuff has to be figured out. So it's certainly not easy. I mean, to have someone approach you, Louis, and say, I've got all this money. I want you to go out and find something and I'll provide the money and you can run it, sounds great. And there are totally wealthy people out there that have a lot of money that are trying to do this kind of thing. A traditional search fund model is basically wealthy people who are putting in some money to basically pay for, in most cases, an MBA grad from a top name school to spend 2 years of their life looking for a good deal upon which the wealthy person can then invest further. That's what the traditional search fund model is, right? And so for a person that is, got tens of millions of dollars or whatever, to go be dropping, 50 grand into a search fund to then potentially get opportunities to put in a few $1 million makes perfect sense for them. If this is a person who has never done a deal, if this is a person who has worked all their life saving money and they've got a bank account that happens to have $1 million in it, then the likelihood of issues coming up with respect to, their sophistication, their understanding of what the deal should look like, their understanding of what they're going to be doing, their appetite for risk, their desire for comforts, you know, in any acquisition deal for a business, if it's a good business, the price you pay for the business is going to exceed the tangible value of the assets within the business. That is literally the accounting definition of goodwill. It's that difference between the two. And so that investor, if they're going to give you all the money to make the acquisition, they will not be covered with asset value, right? They're going to be out on a limb to a certain degree, and they're going to be out on a limb with somebody operating the business day to day who has not got skin in the game, who has not made an investment. Now, you may argue, Louis, that you're going to fight like crazy to make the deal work because maybe you end up just contributing sweat equity and you end up owning a significant portion of this, and it's the best opportunity you've ever had in your life. I have seen instances exactly mirroring what you're talking about, where people have bought businesses and some of them even have contributed money of their own. But over the course of time, when things went south, their investors, their backers, their white knights, whatever you want to call them, put in more and more money. Their own money was clearly not going to be ever resuscitated or taken back out of the business. And eventually, those entrepreneurs got frustrated, threw up their hands, and walked away and quit. Some of them declared bankruptcy. And then the investors just kind of like lost everything. So those are the kinds of stories that everyone's going to want to tell this investor. And so you have to be prepared for anything that could happen. And, you know, at least with a bank, you're talking about professional lenders who are going to look at and analyze a deal using certain parameters, and who can likely be trusted to approve deals that meet certain criteria that they have, right? Like that's how if banks didn't approve loans, they would be out of business. That's their business. When it comes to private investor, um, it's really not done until it's done, until the checks have cleared and money's in hand, and then you could end up buying a business and then end up in a really bad working relationship with someone who maybe doesn't quite understand the same way that you did about what the day-to-day involvement was going to be after the deal was over. Anyway, great question. Thank you very much, Louis, for sending that in. As I said earlier, I'm doing lots of work these days on the whole raising of private money because that is the next bonus module that is being built for Business Buyer Advantage. It's going to be all about raising private capital, both debt and equity, for Main Street and the smaller, lower middle market deals. So a lot of the content that you will find out there, I mentioned search funds earlier. A lot of the content you're going to find on structuring deals, having investors, etc., is built for those size of deals. And they don't the advice doesn't quite translate when you get down into the smaller deals, because the plan and the interests and the desires of the business owners and the investors are not quite the same. And so, if you're interested in this, make sure you sign up for Business Buyer Advantage. When the new module drops, all the old students, the past and present students of the program, all get access to the new stuff. If you are a Business Buyer Advantage student, you haven't logged in a while, there were a bunch of new modules added last year and earlier in 2024 as well. And so this will be out before Christmas, and working on it all the time and looking forward to it. Anyway, with that, we'll say thank you very much. Keep the questions coming. I love making the videos. I love answering them. One of these days, I will definitely budget some money for some nice like sound effects and all that kind of stuff to make the videos more interesting. But until then, you'll just have to focus on my voice, keep an open mind, and just try to focus. I know it's hard without the sound effects and the flying saucers and the Smurfs and the Munchkins and all that kind of stuff. I know it's tough. Anyway, we'll see you soon. Cheers.
So, how can you learn more about buying, selling, financing, and managing small and medium sized businesses? Easy. Go over to my blog site, davidcbarnett.com, where you can learn more about me and how I work with my clients. You can learn more about my books and courses that I've prepared for you. You can find out how to subscribe to my email list, the YouTube playlists, and more. There's literally hundreds of hours of content there, all for free, and I'd love for you to be my guest.